All right, let's just jump right into this. Welcome to this explainer, where today we're putting on our skeptical equity research analyst hats. Our singular goal here is to completely strip away the headline hype, ignore the market noise, and run Synchrony Financial, ticker symbol SYF, through a rigorous, purely objective financial case study. We're using their latest Q2 2026 data, acting as investigative journalists of their financial statements. And trust me, we brought the receipts. But before we deploy a single model, we have to establish our baseline compliance regarding our analysis of SYF's publicly available Q2 filings. Disclaimer: this is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism. Okay, with the legal out of the way, here is our investigative syllabus for today. First, a 21-model valuation gauntlet. Second, uncovering 14 buried flags the media completely missed. Third, a reality check from investing legends. And finally, a BS-free verdict on their economic moat. Phase 1, the ultimate valuation gauntlet. Let's get to it. We'll start by benchmarking SYF's current $76 price tag against our first group of models, which focus on cash flow. Standard discounted cash flow and unlevered free cash flow sit tightly between $85 and $98 per share. But watch what happens when we shift our focus specifically to the shareholder. The free cash flow to equity model literally spikes to $115. Why? Well, management is aggressively buying back $850 million in stock. The sheer weight of those cash flows proves a massive underlying shareholder yield. Even our adjusted present value model factors in their huge interest expense tax shields to easily clear that $92 to $102 range. Moving right along to dividend and income models. Now, standard dividend discounting actually lags the current price, hovering in the $65 to $75 range. But the real story here is tucked away in their excess earnings. The residual income model screams undervalued at $110 to $120. Synchrony boasts a robust 21.4% return on equity against a massive $16.9 billion book value. They're generating incredible excess capital above their cost, and that is perfectly mirrored in our economic value added model, which lands firmly above $105. When we look at comparables, there's one metric that just absolutely steals the show: the P/E ratio. Synchrony is trading at a highly compressed forward P/E of just 8.1. If we assume a totally standard 10 to 12 multiple on their FY26 EPS guidance, intrinsic value instantly jumps to between $93 and $113. You compare that to historical acquisition premiums for an asset with 68 million active accounts, or their EV to sales based on a record $49.8 billion purchase volume, you're looking at severe sector undervaluation across the board. Now, things get wild when we look at the balance sheet. Our calculated book value sits at exactly $52 per share. If everything went terribly wrong tomorrow and they had to fire sale their $102.2 billion loan book, liquidation value would drop to roughly $35 to $45. But let's be real for a second. The cost to organically rebuild their deeply entrenched retailer share arrangements and co-brand network from scratch today, actually, it's kind of like trying to buy a house for the price of its plumbing. It's nearly impossible. That replacement cost pushes intrinsic value right back up to a rigid $80 to $100 per share. Finally, wrapping up the gauntlet with advanced options. Applying real options valuation logic using a Black-Scholes framework, we account for management's brand new artificial intelligence investments. Plus, they're expanding medical networks like Amerivet. Doing this yields a considerable upside premium of $95 to $115 a share. So that's the quantitative side. But as we all know, numbers only tell half the story. Phase 2, the media blackout flags. Okay, let's step away from the models, act like real investigative journalists for a minute, and dig straight into the footnotes. We actually found 7 major red flags the headline media completely missed because they were too busy cheering an EPS beat. For starters, provision for credit losses spiked to $1.2 billion while reserve releases plummeted, details far too nuanced for quick TV soundbite, and actual net earnings down 8%. That was totally glossed over because massive buybacks artificially inflated the per-share headline. Add in an uptick in the efficiency ratio, a drop in ROA and ROE, and a dip in the liquidity portfolio yield, and we are looking at some undeniable underlying stress that the evening news is just completely ignoring. But on the flip side, look at the green flags they buried. a record $49.8 billion in purchase volume, and a 23% surge in co-branded card volume. That proves consumer spending resilience. But hey, consumer strength doesn't sell fear, right? Even better, their net charge-off rate mathematically improved to 5.43%, which actively counters the popular default panic narrative out there. Backed by an 83% deposit funding base, giving them extreme liquidity safety, and those deeply accretive share buybacks, management quietly raised the lower end of their FY26 EPS guidance. And where did they put it? Buried at the very end of the 10Q filing. Phase 3, Legendary Investors Reality Check. Let's ground all this data in reality by applying the strict criteria of 3 investing legends. First up, the father of value investing himself, Ben Graham. Running his strict intrinsic value formula against Synchrony's EPS and book value yields a really exciting Graham number of roughly $104.70. With the stock currently trading under $77 and a PE well below his absolute ceiling of 15, Graham would absolutely declare this a screaming buy. Next, Peter Lynch. Applying his growth-adjusted PEG ratio, where he looks for a PE equal to growth plus the dividend yield, Synchrony actually fails. With net income growth basically flat right now, a PE of 8.1 is technically higher than their near-zero bottom-line growth and 1.7% yield. But what about Warren Buffett? Well, Synchrony easily passes Buffett's criteria, thanks to a massive 21.4% return on equity, consistent share buybacks, and an undeniable economic moat built on deeply entrenched retailer partnerships. Phase 4, Moat and Final Synthesis. Having completed the gauntlet, let's synthesize this whole thing into a final verdict, starting with their economic moat. According to Morningstar, an economic moat relies on 5 key sources. Synchrony's moat is built firmly on powerful network effects and switching costs. This is driven entirely by their deeply integrated retailer share arrangements and co-branded cards spread across 68 million active accounts. You just cannot easily rip out and replace that level of retail integration. So, what's the bottom line here? Based on the average of all 21 financial stress test models utilizing Q2 2026 data, Synchrony Financial is definitively undervalued at its current price. The sheer weight of their cash flow and excess earnings simply drags the average intrinsic value well above current trading levels. And looking ahead, this economic moat is actually expanding. Over the next 3 years, their sticky co-branded partnerships, which, remember, just surged 23% year over year, and their embedded AI technology integrations will aggressively widen their switching costs. Competitors simply cannot replicate this kind of integration and extreme deposit funding overnight. However, we have to leave you with a more nuanced takeaway. Yes, the massive $850 million capital return provides a rigid valuation floor, which heavily protects the downside. But you absolutely cannot ignore the buried red flags we uncovered, specifically those elevated $1.2 billion credit provisions and the rising efficiency ratios. These signal undeniable macroeconomic storm clouds on the horizon that all this media EPS hype is conveniently hiding. And honestly, this brilliantly illustrates the real tension in financial analysis. The quantitative models are pointing one way, screaming undervalued. But those qualitative hidden flags, they suggest a credit storm might be brewing. So what does this all mean for you? Which side are you on? As always, take this data, run it through your own thesis, and do your own homework. Thanks for learning with us today on This Explainer.